I want you to explain to all of our audience, and particularly the audience fixated on the Dow, why everybody in the Ritholtz world focuses on rates.
Well, the risk-free rate of return is your frame of reference relative to what sort of expected returns you can have in the equity markets and how much risk is out there. So when companies can borrow at no cost, it makes them more profitable and their stocks go higher. When consumers could get mortgages at 3% or 4%, it leaves that much more jingle in their pockets to spend and to drive retail sales. So the concern has always been there's no such thing as a free lunch. And if you keep rates down for too long, you'll kick off another inflationary spiral. Rates have been way below normal since before 9/11 in 2001. So that's 20 years already. That idea needs to be rethunk, because so far it ain't so.
Well, I like that. Rethunk. That's CFA level 4. Barry, Kathy Wood talks about how we will see growth and value participate, which to me goes to another theme of our morning, which is that corporate officers will adapt. Are we underestimating how corporate officers on a microcosm basis will adapt to stimulus? They'll adapt to pandemic change.
I mean, last time we had a conversation about how CEOs were one of the last groups standing in the public opinion polls because they adapted so well in 2020. But those are bigger companies. When we talk about adaptation, especially innovation, you have to look at the small companies. You have to look at the startups, because that's what drives the major economic changes. It's just over an arc of years and decades. Eventually, big companies catch up. Look no further than Tesla. People forget they've been around a dozen years, and they've completely changed the rest of the automobile industry. Nobody wants to get Amazoned by Tesla. And so, rather than lose, they adapted to EVs.
Well, sure. And Barry, that's the specific story when it comes to Tesla. There is a larger story here, though, that we've brought forward and that we've bought ourselves a bunch of years to grow into the valuations that we've given some of these equities. We've brought forward the returns. The equities have outperformed the economy, and now the economy will have time to catch up while equities underperform. Do you buy into that story?
Sure. I mean, it's certainly one possible path we can take. The old joke on trading desks is just because something's overvalued doesn't mean it can't stay overvalued for years and years and years. When you look at the long-term secular bull markets, anywhere between half and 3/4 of the gains come not from increases in earnings, but from multiple expansion, meaning investor sentiment gets more and more optimistic. They're willing to pay more and more for that same dollar of earnings.
Right.
We're kind of along the way in that process. It's a lot of PE expansion has taken place over the past decade.
Lisa, I want to point out NASDAQ up 300 points, up 2.5% now.
Almost completely erasing yesterday's losses, which raises a question, Barry, what it will take for people not to just buy the dip.
Well, it takes a long time to change that muscle memory. And you have to keep in mind, I mentioned secular bull markets. This 10% correction, 20% bear market is just utter nonsense. It's a terrible trope, and I think it hurts investors when they think about that. A bull market is not only that sentiment shift in terms of increasing willingness to pay up for a dollar of earnings, it's huge secular forces that change things. And that includes everything from technology and biotech and just how the economy shifts. The classic example is post-World War II, when you had the rise of the automobile and suburbanization, and go down the list. There were so many things, electronics and commercial aviation. We have 100 separate industries that are all moving forward. Just look at what took place with mRNA. This was a glint in scientists' eyes 20 years ago, and now it's a game changer. There are hundreds of technologies like that. You guys know me. I'm not a permabull. Remember back to the great financial crisis. No one was more bearish than me. There are a lot of things to be optimistic about if you have a long-term perspective, a 10-year perspective.